Welcome to Millionaire Mindset, where we give you ways and advice to achieve financial freedom. You probably want to accumulate wealth or at least have enough investments to take care of you at retirement. That is why in this video we will teach you all about investment allocation. It is a principle that you can use to maximize profits while minimizing the risk of investing in just one asset class. It's the opposite of putting all of your eggs in one basket. You need to learn how to spread your investments across asset classes. So, you better stay tuned until the end because this is an important lesson. Without further ado, let's jump right into it. First, let's clearly define what investment allocation is. It attempts to balance the risk on investment by spreading assets among different investment classes by ratio. Each investment class has different levels of risk and reward. Each will have different behaviors over the long run. That is why investment allocation is important because it allows you the freedom to choose an investment plan that's the most suitable to you based on your goals, age, and ambition. You can take advantage of the compounding effect and a time value of money. Asset allocation offers you protection against a significant investment loss should things ever go wrong in one investment class. Next, let's discuss these different classes quickly. We have three main types: stocks, bonds, and cash or money market securities. And these are further divided into subclasses, one of which is called large cap stocks. These are shares issued by companies with a market capitalization above $10 billion. In contrast, mid-cap stocks have a market capitalization between $2 billion and $10 billion. And if it's fewer than $2 billion, it falls within small-cap stocks. Generally, these equities will have a higher risk because their liquidity is lower. Other subclasses include fixed income securities. These are highly rated corporate or government bonds that pay the holder a certain interest. The interests are paid periodically or at maturity. They are less volatile and riskier than stocks. Meanwhile, international securities are any security issued by a foreign company and listed on a foreign exchange. And emerging markets are securities issued by companies and developing nations. Investing in emerging markets offer a high potential return, but increases risk. The risk resulting from unstable policies and structures in those countries and the lower liquidity. Real estate investment trusts or REITs involve picking up shares in investors' holdings of mortgages or properties. And money markets include investments in short-term debt for usually a year or less. The most common money market investment is treasury bills. With these, you should start to form how your portfolio would look like. Your ideal asset allocation should be a mix of investments from most volatile to the safest. That way, you could maximize the return on investment or ROI over time. Your selection should include stocks, bonds, and cash or money market securities. Note that percentage of your portfolio depends on the time frame and risk tolerance. You must understand that this isn't a one-time decision. You will need to revisit your choices from time to time to see if they're still meeting your needs and goals. If you need to make adjustments in some places, you may have to make the required adjustments. For instance, a much younger person can be more daring in their choices, but getting closer to retirement has to be much more conservative. So if we take a look at this example, Brian, who is a 21-year-old college graduate and just started working, decided to put 80% of his investment on stock, 10% on bonds, and 10% in the money market securities. He takes this decision because he's planning long-term. He does not have to bother about the fluctuation in stock prices or the crashes that could happen in the market within those years. He knows that his investment will have grown massively in the next couple of decades. On the other hand, Mark, a 50-year-old worker who's been struggling with his finances, suddenly realized he'd not made enough plans for his retirement, so he will be more conservative in his choices. knowing that time is not on his side and he can't afford to put his money in any risk venture. So he invested 10% only in stocks, 30% in bonds, and 60% in the money market securities. You want to allocate your investments to minimize your risk while also achieving your expected return on investment. To achieve this goal, you must understand the level of risk involved in the various classes of assets. Equities such as stocks and bonds have the highest potential return on investment, but they also command a high risk factor. Money market securities such as treasury bills provide the lowest return on investment but the lowest risk factor. It is because the government backs these bills. Investors who have higher risk tolerance can go for higher risk choices. A young investor can build a long-term investment portfolio knowing that he still has enough time to recover any losses no matter what happens mid-term. Everyone wants to retire with a sizable volume of assets in a secure investment. Spreading your assets through investment allocation is essential because every investment has risk and market fluctuations. When done correctly, investment allocation protects your whole portfolio from the ups and downs that come with holding a single class of assets. You can choose a part of your portfolio to contain more volatile securities because you want higher returns. But you should assign the other part to more stable assets. So if your volatile investments screw up, your more stable assets will immediately lend their hand to pick you back up. Now that you know investment allocation, you must keep watching these factors. The first is your emotions. Everyone loves profit. We all decide the highest possible returns on investment. But you must keep your emotions in check when picking an investment portfolio. Selecting the assets with the highest potential might not be the answer. And there are so many shady offers there that might persuade you just because they're showing you high returns. Think logically, not emotionally. The ability to assess the risk and return on investment separates a successful investor from the greedy one. Also, emotion will make you panic when a short-term market crisis happens. You must know that fluctuations of a backward market could last for months and sometimes years. That is also why you must not put all of your money in just one investment. It will keep you sane during low times. The next is your goals. Different people have different goals, and we have no idea what are your goals. You can only answer that yourself. That is why it is vital to know your specific goals when making asset allocation decisions. Also, as you approach retirement, you should adjust your portfolio to hold fewer high-risk assets. Move more of your investment to fixed income assets that are more stable and safer. The third thing is time. Think of it like this. If you plan to hold your investments for a long time, say 30 to 40 years, then sudden fluctuations will not affect you one bit. Also, starting on time permits you to take advantage of the compounding effect and time value. It also offers you the benefit of going into high-risk, high-return investments. The more time you have, the less scared you should be. Having said that, if you miss starting on time, don't worry because you're not entirely lost out. However, you must know that there will be more dedication and more sacrifice to be made on your part. According to the U.S. Department of Labor, for every 10 years you delay saving for retirement or some other long-term goal, you should save 3 times as much each month to keep up. Let's look at it this way. Let's pretend you're 48 and you think you should have started at 23. You may conclude that you've lost 25 years already, and therefore there's no need to start again in the next 12 years. You'll be due for retirement whether you start investing today or not. You'll be 60 in 12 years. If you don't start at all, in 12 years, you'll have nothing. But if you start today, in 12 years, you will have something. It's better to start late than not start at all. And speaking of start, the last thing that you should look out for is just start. You must keep the ball rolling as soon as possible. Have it in mind that it's never too early to start and it's never too late either. Once you identify the right combination of stocks, bonds, and other assets, it's time to allocate your investment. That's our video for today. We hope you liked that one and learned about investment allocation. Tell us about your experience with investing. Do you have specific strategies? We love to hear about them. Join us again in Millionaire Mindset for another round of tips in achieving your financial freedom. Don't forget to like, comment, and subscribe.